question. If a client asks you tomorrow, what is private credit? Where do the returns come from? And what are the risks? If you hesitated right then, you're not alone. Hello and welcome back to Inside Private Credit. My name is Damian Casey. I'm Head of Distribution at Woodbridge Capital and giving AT a spell today on the bench. I'm joined today by James O'Reilly, financial planner, founder of Northeast Financial and co-host of the Australian Retirement Podcast. Welcome,
Hello,
mate. How are you?
Yeah, I'm well. I'm looking forward to this. This is supposed to be really easy, isn't it? Is that what you were telling me?
Absolutely, mate.
I'm
Absolutely.
not feeling that's going to be the reality, but it's good to be here.
Yeah, pleasure, mate. As I've seen earlier, James is, of course, a podcast star, very comfortable on the podcast dance floor. So I thought, well, what a time to give this guy a grilling and really ask the questions, that I think every advisor is being asked on a daily basis. Why can I ask you, James? Because, mate, day in, day out, this is what you are doing. You are sitting there front and centre at the coalface answering these questions from clients on a daily. So, mate, private credit, of course, is becoming, more of a common conversation in client portfolios. And I wouldn't just say in ultra-high net worths or what we call wholesale landscape. It is floating into retail. But it is definitely still an unfamiliar asset class, isn't it?
Yeah, it definitely is. I think we're getting a lot better at communicating it, and we're getting better at understanding what it is, broadly advisors, but it sort of gets forgotten about, doesn't it? Advisors, we have our hat on and we're constantly thinking about equities, and you most mornings, most advisors would jump onto the AFR or something, or Yahoo Finance, or like, how did the S&P 500 finish yesterday or whatever, but we don't do that for private credit. The information's not as freely available, and it's just not front of mind like equities are. Yeah,
true. And I suppose it's, advisors just need to be able to explain what private credit is, where it fits, and how risk returns work. I think, that's a starting point, which I think is still really misunderstood.
Yeah, I agree.
As you know, clients are hearing more and more about private credit, from LinkedIn to media to, Sunday afternoon over a barbecue at the neighbour's house. Why do advisors really need to be ready with the information when the questions come over?
Demand's rising, right? There's the private credit is increasingly becoming a big driver of portfolio returns for a lot of Australians. If we rewind 20 years, 30 years, private credit was basically family offices, ultra high net worth or wealth. That was it.
It was.
As wonderfully as Australians get more financially literate, as so many people want to take more control of their finances and have the tools to be able to do that, including some great education like the stuff that you guys are putting out.
True.
Then Australians are starting to learn more about these sort of investments and know what they are. So I guess that's side number one, if I may, which is that demand is rising. So commensurately, there's more products available to meet demand. So the breadth of private credit is becoming a bigger thing. But the other part of this is that it's unregulated in certainly compared to most other assets that advisors are familiar with. And I personally think, I welcome your comments, but I feel as though the regulation is not keeping pace with how quickly the private credit is growing. And I think there's some good steps being taken, but for advisors, it really is important to be across this well. It's not enough to just broadly have a sense for it. If you're going to recommend it, you want to be asking the right questions to private credit managers, and you want to properly understand what these funds do, because otherwise being caught out in private credit, like any asset, can really suck.
Oh, it can, and it can mean putting in the wrong part of a portfolio, because you thought the risk was this, when you didn't really, I suppose, fully understand the risk. And as part of our Woodbridge learning, we talk a lot about that. We're very, very black and white with clients and saying that, remember, we are totally unregulated. just remember that. Like myself and you, would have come up through uni and through our careers in a regulated environment. With shares and equities and all that kind of stuff. The stuff that we come up with in portfolios, it was all regulated. So when we talk about external trustees, the everyday advisor goes, what? And then, as I said, that's a big form of, external kind of, I think, ownership and external oversight that advisors need to understand, which we'll touch on later. But I think that I suppose. What do you think? Why do you think it still remains misunderstood by so many advisors, like private credit in general? Is it just because it's so broad and they don't know how to split it up, or what is it?
Yeah, well, it's probably because, firstly, it's increasingly broad. Like, rapidly, the private credit offerings are getting bigger, or the number of them available is becoming bigger. number one. Number two, I think, as advisors, certainly my mind naturally when I'm thinking about investment portfolios, when I naturally turn my head to the stuff that I know. I feel as though most advisors could pretty confidently speak to the state of equity markets, could pretty confidently speak to, even if it's not in their field of expertise, domestic real estate, for example. Why? We're not licensed to give domestic real estate, but it's what we know. You follow it and you're attuned to it.
True.
Private credit is it just doesn't get the same level of attention unless there are problems, which probably, if anything, results in advisors being a little bit more hesitant rather than embracing it.
And I think that's one thing. Like we always use the example around the Australian equities market. You don't put all the Australian equities in one bucket. Large caps, mids, small, for example. It's not all in one bucket. It's separated, and I think that's a big thing. We do a lot in Woodbridge Learning is just trying to get the client to split things up. Each risk has its return, and that risk needs to match its return. And I think that's where I think we get a little bit confused, and advisors get confused in trying to match us up. As I said, and link one to the other and say, well, you're the same as that. And that's once again, how many hours in the day do you have, James, to do that? You don't. So 9 times out of 10, the advisor will go, I've just got to move on. I don't have the space because I've got so much information, whether it be from media, whether it be from LinkedIn and whatnot, that, if it's uncertain, like anything, our viewpoint, if it's grey, walk away. You know what I mean? And I think the everyday advisor too is in the same thing, So would you agree with that? Is that
I definitely
you're
think
on the
so.
seat? Like,
I would absolutely agree with that.
I suppose that the first question is like, when an advisor asks the age-old question, what is private credit? Like, how do you explain it without still being there half an hour later?
Confirming, you're talking about when a client asks you about private credit, right?
Correct.
Not an advisor? Yeah.
Absolutely. Yes. Sorry, when a client asks
This is you working with advisors every day.
Yes.
I think you've got to keep the explanation as simple as possible. And if the simpler you can start this explanation, the easier all of the subsequent explanations are going to be, right?
Yeah.
Private credit is just direct lending without going through a bank. That's the simplest way you can put it. And you can go on to explain, one or more investors are going to stump up the money for a borrower that needs it for a certain purpose. And they're going to be borrowing that money presumably on lending terms that are not too dissimilar to the lending terms that you'd be familiar with. How long is it going to take before the loan's repaid and on what terms? What sort of interest rate is going to be applicable? What happens if things go wrong? All of that's going to be really well set out at the beginning of the loan, and it's going to ultimately those terms are going to depend on what you're borrowing the money for, right? But very simply, it's when a borrower needs access to capital, and for whatever reason, there can be lots of reasons, which we'll probably talk about. It's not appropriate or optimal to go through traditional bank lending. That's private credit.
And of course, different things come with it, of course, in return and et cetera like that. So I suppose the question does come through is around just how the returns come from. Do clients actually ask you, how do these returns come about? Do they go into that level, or is it kept very high level with a fund that you're using in private credit, whether it be a corporate debt fund or an asset-backed fund, Are they asking that level? Are they asking where does the return come from, or are they not really going into that detail?
They're not asking, but also, there's a truckload of things I don't get asked as an advisor, and I still explain them anyway. And I think that private credit is a good example. That kind of that question is a good example of an unasked question that should be answered. Not just for today. If you're speaking with someone who's either interested in private credit or you feel they might be a good candidate to have some exposure to private credit, but also because it's improving their learnings to the extent whereby you're probably better equipped to have conversations with them in the future about it. I would always take some time to explain why private credit works, the fact that, of course, you're getting the return that comes from the loan, and more often than not, if someone is going, or a group or organisation, company, whatever it would be, is going to borrow money in a non-bank lending way, more often than not, they're going to pay a premium on that. And that's one of the reasons that private credit can be so attractive, right? Is because you're going to get often a higher rate of return than you would be getting if you were to put your money in the bank in a term deposit or one of those sorts of things. The risks are very different. It might look the same externally. So I just hand the money over and I can get it back when I want. And I get 7%, for example. And it's like, yes, but air brakes, that's yes, but you really have to understand what's happening when you hand the money over. versus what happens when you give the money to a bank and put it in a term deposit of 4%, for example.
Yeah, exactly. And I think that's where we then start to split up the loans, I think, because as I said, depending whether it's a first mortgage loan or a second loan, the second mezzanine loan that sits behind first, there's a lot of different, I suppose, risks that overlay that. But, I suppose we get asked a lot about, examples, of how we get income and where the income comes from. For example, with us was pretty much, a commercial borrower is wanting to buy an industrial asset. They need funding to help complete that asset. We'll do a first mortgage loan that'll be secured against the asset, of course. Off the back of that, of course, will be interest. And then, of course, that is how the income is derived from the loan. So it's it's as pretty straightforward, as simple as you'd expect. Some strategies, they only do one type of loan, so they're all coming from one sort, and then of course there are other sorts of funds that will blend that, which is another story that comes off the back. But
I'm going to fire a question without notice at you here, if that's all right, please, because I feel as though you're talking about first mortgage loans, and I think it's very, very, very important to understand the significance of a first mortgage loan versus being second tier or something along those lines, right? Yeah. Especially for Australian private credit. And
also, and I think probably the best thing is the Australian first mortgage law, which is it's very, very good to the borrower, very good for the lender, but definitely not the borrower. So I suppose a first mortgage loan just means that they have full control over the asset. They have the ability to step in on that asset any day of the week they like. And I suppose that's how people talk around preserving capital and stuff like that. But I suppose when you look at the controls and the protections, that the lender has in first mortgage law, it is quite amazing. And of course, it's very different, to the US. So, that's kind of a very basic kind of look at it. But pretty much it just means that, at any time, the first mortgagee can step in and they can sell that asset for the LVR in which they're at. So if it's a 60 LVR, they can potentially sell that asset for 61 cents in the dollar. That just means that they can get rid of that asset quickly and, of course, move on to the next loan and, of course, preserve that dollar. So,
and I think to add to that, the understanding the implications of that, it does protect a private credit offering much more because you in order to have actual loss of capital under an investment like that, you need two things to happen. Firstly, you need a default to happen. I can't meet my debt obligations, and so the loan is going to get wound up. More often than not, failure to meet debt obligations. And then the second one is that the investment has fallen by more than can realistically be recovered when that asset is sold. And so when you're thinking about real estate-backed assets, for example, the probability of both of those things happening, especially a really sizable fall in real estate in Australia, is should give a much higher level of confidence to an investor than if they're trying to chase similar returns in a private equity space, for example. But now we don't have the same first mortgage laws, and it's based on what's the business worth rather than what's the real estate. What is this fixed real estate worth? The risks are very different, right? And this speaks to the fact that across all of the different private credit offerings, which grow at this amazing clip all of the time, being able to, as an advisor, cut through and understand what is the end product here, and then what happens when things go bad. It's essential to understand if you want to recommend private credit.
I could not agree more. I think, once again, it just comes back to that risk. It comes back to understanding the risks and understanding what can happen if something goes wrong.
Yeah.
It's very, very important to understand these LVRs because they mean so much to you. But most importantly, the V that sits in the middle is just so important for the advisor to really understand that if you don't know where that valuation's coming from, then really, how can you really stand behind that LVR, of course, especially when you've got to step in on an asset. So I think when you're explaining private credit, how easy is it, to get stuck down a rabbit hole, to not go technical, to keep it simple, in a crayon? Like, do you find that over the years, because you've been using, private credit strategies for a couple of years now, have you kind of changed the way you talk about it to just keep it in crayon without getting kind of stuck down that rabbit hole, or what has changed?
Yes, I definitely have made a conscious effort to try to keep it simple. You know, as a quick, we were talking about equities before. I'll share something that I identified that came up a couple of years ago that was a huge source of embarrassment for me.
Yeah.
So lovely to share it on a podcast. Which was that I was talking to someone was coming through, and we would provide a statement of advice for them, and I was talking through everything, and I was talking about the investments and where their money was going to be allocated. And I got a fair way along talking about, we're thinking about allocating money here and here and here. And I got much further along than I care to admit. And the question came back, so now just to be clear, what's an ETF? Right? Totally reasonable question. And it just floored me because of I, throughout my career, always made a really concerted effort to avoid that kind of language, make things really clear and easy to understand, and meet people where they are, assume that people have a low knowledge base until they show otherwise.
Yeah.
And somewhere along the way, I just sort of lost that. I'd gone into autopilot of just, I figure you know what this is, so let's get on with it. I have no idea when that happened, but it must have happened at some point where I've just started explaining it as an ETF, and people have nodded and agreed with me, and I've just gone on with that, and I've never stopped to correct myself again. And I feel as though, you do have to make a concerted effort, not just with these sorts of products, but any products to avoid the assumptive jargon. The jargon where I assume you know what that means, so I'm going to keep moving, because it can be pretty overwhelming for people. Now, thinking about this kind of stuff, and specifically around private credit, the crayon way that I like to describe this is just, why does it exist?
Yep.
That's as far as I'm concerned, the simplest way that it can be explained. It exists because there are borrowers out there that require money, they require lending, and they're going to struggle to get it from a bank. And there can be lots of reasons for that. Sometimes it's because it's outside the bank's appetite, for example. Sometimes the borrower might want more flexibility than a bank would traditionally offer. Sometimes it could exceed bank lending limits. There's lots of very legitimate reasons. Sometimes it's because the quality of the deal is just below the standard of a bank. And of course that can give rise to both opportunities and problems, depending on how it's communicated and who wants to take that debt. But the borrower wants to get access to capital that wouldn't, and their preference would be not to use a bank. And so they're saying, well, how are we going to get this loan? And someone is willing to step in, whether it's an individual or a pooled group of people, which of course, like if we think about Woodbridge, they're pooling assets together from people that are willing to invest that way, and saying, as long as the underlying assets are well, and as long as the lending makes sense, we're happy to take that deal. We'll take it, and we'll charge you a premium, because otherwise, otherwise you just go straight to a bank and have a lower cost, and that works for both of us. We manage the risk premium, and you get the funding that you need.
Yeah, I think probably one thing there I'll just kind of touch on is that I suppose it's not they can't get funding from the bank. It's just, as I said, as you can imagine, when we've seen changes in regulation a few years back where banks had to tighten up, is that especially in commercial real estate, they just can't lend anymore. You just can't get the funding unless you're in that box. And I think the biggest thing for most developers, I think, across is time. They need it quickly, and they need it before 6 months. And a lot of banks, it's very slow, and it's meant the non-bank world has really kind of taken over that space and competing against that same debt. But as you can imagine, because due diligence can be done quicker, a lot easier in the feet without the red tape, it just means, you pay a premium for it, of course, and that's kind of where, and the idea with a lot of these funds is that, you take that debt for 12, 18 months, and then of course, when they're ready, gives it back to the bank. And I think that's, way a lot of the biggest shops do it as well, is that just trying to go, we'll sort you out in the early times, of course, with severe due diligence, of course, and then once they're sorted things out, because the biggest thing with a lot of these, a lot of lenders is, not really where's the money, it's where's it going next.
Yes.
The exit plan is what, a lot of lenders call it. Before most loans, and probably a lot of managers are written, they know where it's going next. They know how they're getting their money back. And that's so important in our world, because anyone, me and you, can borrow money. We can give it away, but it's getting that back is where a lot of these, a lot of managers in our world get paid. And that's the really important part. So I think we always come back to, client portfolios, because they are everything, and, the SMA world has exploded. Where are you typically kind of seeing these private credit funds put in your portfolios, for example? Is there one particular section, or, is it different amongst clients? What does that look like?
Yeah, it does feature in a lot of our our members' portfolios. But as a small sleeve, I know there was some great conversations. That you've of course got your Woodbridge Learning, which is on the website, and it has some really good podcasts. And one of those in there I remember listening to recently, and it was talking about where private credit sits. Is it a defensive asset? Is it just purely defensive? Is it alternative? Is it in the growth sleeve? Where exactly does it sit? And I'm trying to remember what his name was. He's a CIO at Tralia.
Jonathan Taleb.
Yeah, that's right. Yeah, and he had a really good observation, which is that this is more about managing liquidity risk. This is a liquidity-based conversation more than it's a growth and defensive conversation. I thought he said that really, really well. Because I think it does have a good place in client portfolios. Like for advisors, why would we recommend it? Well, generally speaking, we're looking at a non-correlated asset, number one. So it's regardless of what's happening in markets, and especially investment markets, broadly equity markets, we can have a level of stability in the portfolio that when it does move, it's not correlated traditionally to what equity markets do. We also end up with a bolstered income side. So especially if we're looking at pre-retirees and the like, and retirees, and trying to make sure that we get a good level of return for them to meet their own lifestyle requirements, that's a terrific way to do it. The key thing for mine, as Jonathan pointed out, was that question of how much exposure should you have to that level of illiquidity. Now, private credit funds, hopefully most of the time, are relatively liquid in the sense that within, let's say for simplicity, 30 days, max 90 days, you're going to be able to get your funds back. I'm going to request the money back today, and sometime in the next month or so that will come into the account. So the liquidity is, when we talk about this, is right. It's not so much around the good times, it's the liquidity or the illiquidity that can happen in a bad time, where we're in a worst case scenario, we do say, okay, well, a sleeve of the portfolio we actually can't touch at the moment. The focus is on preserving your capital and getting all of your money back. But the trade-off to do that is that we just need to be a little bit more patient in terms of waiting for that money to come through. So low risk, depending on where your money is invested and the questions you ask the fund manager and how well, like what sort of governance they have and what sort of framework that they have to manage that capital. But yeah, for mine, I think it can form a really good part of portfolios as long as it's really well understood and, importantly, it's well communicated to people.
And I think the thing I've noticed in the last, I suppose definitely this year, is the more and more conversations I'm kind of seeing around, like, since when did all client portfolios have to be daily liquid? When did that come in? Like, it just feels like that this mindset, and I heard someone say it again in a podcast a couple of days ago that, especially the retail investor, they need to know they can get their money at any time, which I don't really agree, because, if that's, of course, superannuation money, for example, can't touch it. And even, of course, if it's an investment or whatnot, this mindset around really mixing us up or mixing up funds that are like monthly liquidity to, the age-old PE funds that were 7-year lockups and whatnot. And I think that, if you're using these strategies correctly as I said, and looking at it more, and Jonathan mentioned this, don't look at it where it goes in the portfolio. Don't know about that. He said, look at it from a liquidity perspective. And what is that liquidity premium got to be on a black swan event that, these funds could be locked up for 12 months? I think that's more the question advisors should be kind of looking at, going, well, irrespective of these funds lock up for 6 months or whatnot, they're up in the top end of my portfolio that I don't touch anyway. I've got a number of funds in front of them, that are more daily, that are more liquid, that I can get access to. I don't know. It caught me off guard. I wasn't just be like, why this daily liquidity thing? Why is it? Because I can say in our world, I don't think, personally, I'm not a massive fan, or I don't think that, the understandings of our world in daily liquidity style, is better or worse. I just think it's definitely different, but more hard to understand. But I don't know, mate. Like, you would use.
I'm with you. There's plenty of assets that don't have daily liquidity, and we just accept it. Think about real estate. If investment properties, no one says, I'd love an investment property. Like, let's ignore all of the hoo-ha that's come out of the most recent government budget. If we, we say, I'd love to invest in one, would love to, makes all the sense in the world, can't wait to do it. But what the thing I can't get over is, if I own that property and it's being rented on the 17th of March and I decide I want the money that day, I want it that damn day. Like, no one says that. Everyone's just at peace with the fact that it could take 12 months. I have to wait till my tenant has finished up in at the property, and then I got to stage it, and then I've got to get it on the market, and then I've got it's a huge, long process to get liquidity for real estate, much longer than in almost all cases than private credit, for example. And everyone's like, yep, that's cool. That's the norm.
Australians love real estate.
Yeah, Australians need to love private credit, mate.
And I suppose it's not, and it's not just, it's definitely because a lot of the funds, the bulk of I think that the retail strategies in our world are monthly liquidity, and I kind of always say to clients, that's pretty impressive.
It's pretty good.
It's pretty good. You don't realise we are a liquid, we are, a lot of the loans in these portfolios are, 12, 15 months long, they're not one day. And I think, really understanding that and understanding how you use these funds and looking at the illiquidity premium, and as I said, adding into the fact that if on a black swan event these did lock up for 12 months, how does that change your risk-adjusted return on these type strategies and whatnot? But once again, once you understand the key thing, of course, which is the risk, where is the risk? Where can it go? What are the protections around it? Okay, I understand that. Yeah. What's next? Liquidity. Okay, so this one's at quarterly, this one's at. Does it still make sense? And I always say to advisors all the time, that's for you to tell me. Yeah? That's for you because you know your clients better than I do. As to can they handle that?
I'd be really curious to know. I'm going to fire one at you, please, if I may, which is the idea around advisors evaluating private credit options. You meet with a lot of advisors, and so you've seen hopefully the best questions that have been asked, and you've also seen the questions that probably indicate the advisor's not thinking about this the right way. If an advisor is sitting with a private credit fund manager, whether it's a business development manager or whatever this looks like, and wanting to properly understand whether or not this is a fund which may deserve my client's capital, what are the big questions they should be asking to be able to evaluate that?
Yeah, and it's a hard one. And the first thing I would say is, I do feel sorry for the retail advisor, even the wholesale advisor, because trying to work out and trying to match us up to say which fund competes with which fund is extremely difficult, because, the number one thing that's flared up in the last couple of years is the word transparency. Yeah. And, like my boss always says, there's transparency and there's BS transparency, of course. The top 5 loans in a private credit fund is not an equities portfolio. Yeah. Very, very different. But, I think the number one thing we say to clients all the time is that go back to the first thing we mentioned before, unregulated. Remember, so we don't have a regulator. We don't have someone looking over our shoulder. So external people doing that is a non-negotiable.
Yeah.
So external trustees, these funds, especially retail, they need to have an external trustee, and it needs to be a tier 1, people that know what they're doing, and then that tier 1 external trustee has to have full oversight, not just of the feeder fund. It needs to have business oversight of the whole business.
Yeah.
And I speak very clearly and slowly about this because it's so important. And then, of course, what do those external trustees, what control do they have? Do they sign off on the loans? Do they sign off on the fees? Do they sign off on the valuations?
Yeah.
These kind of things that keep coming up. I ask about, can your fund lever? Can it lever itself? Can you blend? Can you go from first mortgages to second mortgage to corporate debt to pref equity to equipment finance?
And this is stuff that you might look at as an advisor and say, oh, geez, that headline rate is really attractive. The return, but there's a reason for that a lot of the time, right? It's and it might be, for example, because there's leverage in the portfolio. They've collectively raised 50 million and then they borrow another 50 million to lend out 100 million, for example. And we've now got a totally different product than we had before. And the same with the blending. If there's a big difference between a first mortgage fund versus a fund that has mezzanine financing and all those sorts of things throughout.
Yeah, I think that's the biggest thing. And what we always say to clients is, if you can see it and you're happy with it, then that's great. The problem you've got in our world is that because of the unregulated nature is that you may not be seeing the whole picture. So if you've got a fund that is blending and does this, this and this, and you can see it all and you're happy, that's great. Or it's got a leverage in it and you understand it, still think the return's fine, that's good. What we kind of say is you ask those questions, bring them to the light, of course, as we say, do the pub test on the manager. Most of them are blokes like us that, got a bad poker face and can't tell lies. Yeah, so, you'll see it pretty quickly if they can answer quickly. And then I said, once you know, then you go, okay, now I can work out this fund does this, this and this. Yep. and I can see the risk, okay, return is this, liquidity is this, doesn't make sense. Once again, that's up to the advisor. But what you're doing is you're dragging out those questions first and foremost, and they're very basic questions. And, off the back of we go back to it a couple of times, like the Woodbridge learning we do, which is, that crayon, as we call it, back to basics, look at private credit, is that 95% of the time off the back of it, the advisor's saying, now I have a better understanding of, okay, there's more to it, things I've got to look for. But if a manager walks in, I've got no idea what I'm going to ask him. Yeah. And of course, we launched like this. We did the 20 questions, one pager that we did off the back of it that we say to clients, ask us as well. These are 20 questions that will give you a very good indication of what that fund can do, what it does, what it shouldn't, these kind of things. Once you've got that, I think, that's your starting point. You know what I mean? And as I said, the biggest thing I say to clients is you've been dealing with ordinary small cap managers for 20 years. You've done your due diligence, you've teamed up with good ones and you've partnered with them. My apologies, Mr. Advisor, but now you've got to do it in private credit. You've got to work through it, team up and, partner up with managers that give you the full transparency, that give you the clarity, the simplicity, and it can form a good part of the portfolio. But, we just keep going back to that risks and what is, of course, the protections wrapped around it.
Yeah. Speaking of that Woodbridge learning, I'm thinking about that podcast episode that was had equity trustees in to talk about the importance of trustees in private credit. Great episode, and he said something really good in the session. He basically said the independent trustee should feel like a pain in the ass. That like if you're the fund manager, it should be a little irritating sometimes. There should be a lot of exhaustive questions. You go, oh, okay, I'll get that for you too. Fair enough, because that's all part of good governance, right? It's like it's setting a standard for saying, well, you might have your own internal ways of doing things, but in order for us to sign off on this and say we are happy, we're just going to apply a thorough oversight, which we think is appropriate for this asset class.
And that's, as I said, we kind of say to advisors that research ratings are good and they are great, but the external trustee, the touch they have on our business, and Andrew says it all the time, they're a pain in the ass, but you would not have them any other way. Yeah. Because that's the job. They hit you on everything. Yeah. And I think signing off on things like valuations, where'd that valuation come from? And can you override that VAL? No, because external trustees are signed off that you cannot override that VAL. So the VAL is what the VAL is from an independent body. Like small things that, that we're starting to talk more about, but my God, are they important from a risk perspective? Because the V inside an LVR, if it's not legitimate and independent, you really just don't know where you are, especially when you are stepping in on assets.
Yes.
And what you think you're stepping in at once you get another VAL come in. So, so I suppose that's kind of, how we look at that mainly, I get asked a lot about, what are the one things clients should look at when they're looking at us? There isn't just one thing, but I think the thing I would say is just put the return aside for a sec. Do you know what I mean? It is not relevant in the early days. Yeah, the risk is everything. Yeah.
Yeah.
Where is that risk? What can it do? Of course. Do you know what I mean? Spend your time on that.
Yeah.
And then I suppose once you've got that, and as I said, you take one thing out of that, valuations. That's a starting point for now. And then just work your way through it, because returns are returns, at the end of the day. It's got to be the other way around, not the forward way. So,
yeah, I'm with you. To add to that, another thing, like what stands out to me, thinking about conversations with private credit managers is, and I think it's two-way. It's helpful to ask as an advisor, and it's also helpful to just be thinking about as an advisor. Is like paint a picture. How's this going to go bad? Like I'm going to create a hypothetical in my mind, or I'm going to challenge the manager in front of me. Tell me about. Let's imagine we were in a few years' time and this had blown up in the worst way we can imagine. Why did it? And you can water down and or decide what you want to water down as kind of in terms of them saying, well, this is highly, highly, highly unlikely, but we need this and then this and then this to happen. But like we're talking about with those first mortgages, okay, so this would have to happen and then this would have to happen. And those two things are related too. If one thing happened, that heightens the probability of the next thing happening. Like, trying to understand like what would need to get knocked over sequentially before I'd need to be sitting down with my clients and saying, this has gone really, really ugly, and having those discussions, because that's a horrible place to be as an advisor, and that's the worst place that any advisor wants to be in, right? So this is the stitch in time that saves nine.
And remember, James, like, we are not guaranteed. The amount of times I've heard clients say that it's okay, you guys are guaranteed. For me, that's just such a bad picture. We are not guaranteed. We're not an annuity. We're not a term deposit. So there's a reason why our returns are higher, of course. Because of course you can't be arrogant. You've got to make sure you do due diligence, and your touch is immense. But mate, all good things must come to an end, sadly. And look, I've got to pull a pin on
the grilling's
on our
over
chat today, mate. My grilling, and as I said, I'd love to. I think we'll do it again down the track, mate. I think in time to come, we'll sit down again and kind of see what we've learned, and of course, how the asset class has evolved. But mate, as I said, sensational, absolutely. Straight at it, clear, mate, and it's been a pleasure to talk to you today. And look, I hope everybody out there has learned something new. Either it's just one thing. Everything we've talked about today is in the show notes, of course, or you can grab it at woodbridgecapital.com.au/learning. That's it from us. This has been another episode of Inside Private Credit. Thanks again for listening, and we'll see you next month.